So what's up, guys? If you've ever had any reason to learn about Forex, it is important for you to know about the terms, the terminologies that you're going to see. So let us start with some of these terminologies in Forex that people are confused about. It is important for you to know about them. So I'll just briefly show you some of them and explain them in real depth so that you would always remember. The first one is Forex. Forex for short is called foreign exchange. It is the global market where currencies are traded every day. So when you think of it like a marketplace where people buy and sell different currencies, we also know that it is the largest financial market in the world. This is because more than $7 trillion are traded daily. So just like when you're exchanging money, you go for a trip, a Forex trader do the same by buying one currency and selling another so as to make profit. But in a Forex trading, we do this digitally using trading platforms. I'll talk about trading platform as we proceed, but just understand that Forex means foreign exchange, okay? It means foreign exchange. There's not much thing to know about that. Now, the currency pair is the next one terminology I want to talk about. In Forex, currency pairs or currencies are traded in pairs like Euro/USD or GBP/JPY. Now, the first currency, which is Euro/USD in that context, is called the base currency. And the second is the quote currency. The price of these pairs tells you how much of the quote currency is needed in order to buy 1 unit of the base currency. So when you see the price, it tells you, when you see the price of that currency, it tells you how many of the quote currency you need in order to get 1 unit of the base currency. So for example, if Euro USD is let's say 1.10, it means that 1 euro costs $1.1. $1.1. So I hope that is clear. I hope you understand. So the next one I want to talk about is bid, ask, and spread. Bid, ask, and spread. When trading Forex, you will see two prices. When trading Forex, you will see two prices. You will see the bid price. The bid price is the price at which you can sell. This is the price where you can sell. This price tells you this is the price you can sell. The ask price tells you about where you can buy. This is the price at which you can buy. Okay, so what is the difference? The difference between these two, bid and price, is what we call spread. To help you understand what spread is, if Euro USD has a bid of, let's say, 1.1050, and then an ask of 1.1052, the spread in that context is 2 pips. It's two pips. I don't know if you understand. The spread in that context is just 2 pips. So if you take the 1.1050 and 1.1052 and you do the math, the 2 that comes out from it is the spread. So a lower spread means a lower trading cost. So it's something to watch for when trading. Now, this spread are given by your broker. That's how they make their money. That is exactly how they make their money. Sometimes you want to enter a trade, you find out that the spread is too much. The distance is just too much. Some brokers offer a very fair, some are just so exorbitant. Let us look at the next one, pips and lots. A pip is the smallest movement in the Forex. So when price moves like this, bit by bit, that small move, that tick move is what we call a pip. Usually the fourth decimal place, it is in the fourth decimal place. So how can we better understand this? It is very simple. If you pick a price, let's just use Euro USD because it's one of the most popular one. Euro USD, let's say it moves from 1.1050 to 1.1060. We'll call that a 10 pip move. When you minus the first figure from the other one, you get 10 pip. So that move alone gives you 10 pip. Now, Forex is traded in lots. Every trade happens in lots. Now, these lots represent a set of number of currency units. To help you understand it, we have what we call standard lot. Okay, so a standard lot is equal to 100,000 units. Yes, 100,000 units. Now we have the mini lot. The mini lot is equivalent to 10,000 units. We have the micro lot. It's equivalent to 1,000 units. So these units, this lot determines how much profit or loss you make per pip movement. So if you're trading with a micro lot, you are different from someone trading a standard lot. We're going to go deep. This is just the basic. We're just touching the surface. When we go deep, I will dissect everything and show you. But someone who is trading a micro lot is quite different from someone who is trading a standard lot. Someone who is trading a standard lot will make money faster and lose money faster than someone who is trading a micro lot. If market goes in your favor, if you're trading a standard lot, you make massive profit, massive money, because you're trading with a large quantity of units. But if it goes against you, you lose a lot. That's just the difference. Now, we're going to go deep as we proceed in subsequent video. The next one I want to talk about is leverage and margin. This one, the leverage allows traders to control a larger portion with a small investment. So just a small amount of money, the broker offers you a leverage. Some of this leverage comes in ranges like 1:100 leverage. Then you can trade. It means that you can trade like $10,000 with just $100. That's what it means. So it goes on and on. Some you even see unlimited leverage. You understand? But you have to be careful because leverage can increase both your profit and your risks. But margin, when we talk about margin, we are talking about the amount of money that is actually required for you to open a leverage trade. Margin is the amount of money that you need in order to open a leverage trade. So if your margin is low, you will not be able to access more of the leverage they give to you. So if your account balance drops too low, you might face a margin call, which means that you might actually lose what you have. So your broker will just close your trades in order to prevent further losses, because they are the one that offers you that leverage. The next one I want to talk about is long and short. It's very simple. In Forex, you can make money whether the price of the asset goes up or it goes down. But if you do your analysis and you find out that it's going to go up, you choose, or it's going to buy, you choose long, or you choose buy. If you feel it's going to fall, if the asset is going to fall, it's going to go very weak, you choose sell, or you choose you choose short. So sell represents short, long represents buy. So depending on your anticipation of the market. So the next one I want to look at is it is stop loss and take profit. This particular one, it's very important you understand it. So what exactly is stop loss? A stop loss is what you set so that the system can automatically close your trade at a set price in order to limit the amount of losses that would occur if you did not set it. So let's just say, for example, you're trading and you feel that This is how far it can go. This, if market goes below this, I think it's going to go that down and I'm going to lose a lot. So you set your Excel or your stop loss so that when it starts falling, let's say you choose a buy, you feel it's going to rise, but if it starts falling, it goes against you so deep and it gets to your Excel where you set your Excel to close you out of the trade. You just be out of the trade and you can be able to go on with the little losses that you made. If you don't set it, it will wipe out all your accounts if the market keeps falling, depending on the equity that you have. That's just the brief part of it. But Excel goes more deeper than just setting it like this. We have the mental Excel. I don't know if you've heard of that mental Excel, the one you set in your mind and the one you set. Now we look at take profit. Take profit does the same, but in the opposite way. It locks profit for you. So whenever market goes in your favor, so let's say you feel that it's going to rise after you've done your analysis and it's rising, and you are able to tell the market that when it gets to this point, you add it in your trading, that if it gets to this point, sell or close this trade in profit for me, lock in profit. That's what take profit is. So let's say you're not there and market is going and it gets to that point. Let's say it gets to, let's say for example, you're trading Euro USD at 1.100, let's say 1.1000. That's where it is. So you might set a stop loss. Let me use this to explain the stop loss for you. Set a stop loss at 1.0950. That's like 50 pips low. And a take profit at 1.1050, which is 1.1050. That's 50 pips gain. So let's say price now goes in your favor. It added up to 50 pips gain. You've made profit. If it goes against you and it's reduced to 1.0950, you've made losses. Even if you have a lot of funds in your account, it will not eat up to that. That's the last it can go. That is how take profit and stop loss work. Okay. Now the next one on our list is brokers and trading platforms. You will definitely meet this in your trading. So a forex broker, let's just say they are just like a middleman. They connect traders to the forex market. They are the one that creates platforms that gives you the opportunity so you can participate in a $7 trillion that occurs every day in the forex market. So popular trading platforms include the MT4 or MT5, which means MetaTrader 4, MetaTrader 5. It's a very comprehensive platform. It can help you to view your trade, do a lot of things. And we have another one like TradingView, where you can analyze charts, you place trades, and you can also manage your account. But when we talk about brokers are the same set of people who offers you this opportunity. They have a platform. Each broker has a platform for trading. Some have MT4, some have MT5, some have both MT4 and MT5. Some even have their own trading platform where you can trade. Okay. Then the next one I want to talk, I think the list, we're almost done with the list, is fundamental and technical analysis. So what is fundamental analysis? Forex traders use two main types of analysis when they are trying to analyze their charts or looking at the market. For fundamental analysis, this is based on news. It means aside from your research, you always look at news, what is happening in that base currency and also the quote currency. You're trying to compare the news, what is happening, because news also affects trading. Trading is business, it's everyday business. You look at interest rates, you look at the economic events that is currently happening. Are there wars? Are there any issues happening? The employment rates, all these are fundamental analysis. But when we talk about technical analysis, we're looking at using charts. You are just focusing on charts. You look at indicators to predict the price movements. You are mostly interested in price action, what happens to candle, the wick, you're drawing a horizontal line using your Fibonacci, using different forms of indicators just to get by with the market. You are using the technical analysis pattern. So an example, let's say a trader wants to buy USD when the Federal Reserve interest rate is being analyzed. So there's a particular day in the week where this news will be brought out. So you heard about it and you took advantage of it. You are taking charge of the fundamental analysis. So when you are looking at support and resistance on your charts, looking at what moving average is doing to the candle and all that, you are looking at technical analysis. So I'm sure you must have understood everything about some of the things we made mention of. We might not be able to cover everything, in subsequent video we'll talk about many other terminologies, but for now I think this should be okay for you. So now that you know some of the essential forex terms, you are ready to get started. I also want you to remember that trading takes time. It takes a lot of practice. So if you find this video helpful, don't forget to like, subscribe, and even visit our video on YouTube. Subscribe, put the notification bell so that you learn more, you get more forex lessons. Happy trading, guys. Cheers.